Most people spend 40 years working, paying into a pension, and trusting that it'll be enough. Then they retire and realise it isn't. The pension covers the bills, maybe, but not the life they actually wanted. Over the last 12 years, I've built a system that's produced average annual returns of 40% plus, and my clients are seeing the same. In this video, I'm going to show you exactly how it works, why it only needs 5 minutes of your day. Most people have the complete wrong idea of what successful investing needs to look like. They think you've got to spend hours researching different companies. You need to look into all the in-depth details behind it. You need to read the news every day. You need to be stuck to your computer screen watching lines go up and down for hours. This couldn't be further from the truth. To be honest with you, that's actually counterproductive, because not only are you going to get exhausted, it's going to take up all your life and your free time, and it's going to take up a hell of a lot of headspace and create a lot of stress for you. You're also going to end up over-investing, over-trading, and making a lot of mistakes. In fact, the amount of time somebody spends on their investing has no correlation to the results they get from it. People think if I spend more time, I'm going to get better results, better returns. That's not true. Actually, the people who spend the most time on their investing and their trading are probably doing either a very advanced strategy, which requires a hell of a lot of time, but also requires a lot of skill. So it's harder and therefore much more difficult to get serious returns. Or they're making a lot of mistakes along the way, which is why they have to spend so much time on it. Both of those things probably don't sound that appealing to you. So in actual fact, keeping it simple, having a very clear step-by-step of what you do each day in a very short space of time, and just sticking to that and nothing else will make you far more successful in the long term. Now, in my experience, the work you put in the preparation for the investing is the best use of your time. So when it comes to actually implementing it, you only need a few minutes a day. Now, just to be clear, 5 minutes a day isn't some magical shortcut. It's just about prioritizing the things that actually make a difference. So, knowing how to find a company very specifically, knowing how to know when to buy, how much to buy, and where to sell, just having a very straightforward system like that you can follow step by step means that it can't take you more than 5 minutes a day. Everything I'm about to walk you through is the system my clients follow inside the Trade Tribe to build towards exactly this kind of financial and time freedom. If you want me to walk you through it personally, the free masterclass in the description is the best place to start. Let's dive in. So to do my research into the company itself, I always use this website here, FinViz. Great tool for looking at the fundamentals of any company on the US stock market. Up here, I'm going to show you which company I opted for, and I actually looked at Google. Now, the actual real name of Google is Alphabet Inc., in case you didn't know that. So just searching that takes me to the Google stats. Now, you just ignore all the top bit there, but just coming down to the numbers here, which are all of the fundamentals for Google. Now, I know it looks a little bit overwhelming, lots of numbers on the screen, but the reality is you don't need all of that information. We just want to pick out the certain bits that really matter. So you could find out pretty much anything you want to know about Google on here. For example, where it says market cap there, that's just the value of the company. So it's currently sitting at $3,701 billion or $3.7 trillion. You can see what sales they've made here. Incredible, 403 billion, which is obviously a really, really great number and something I would want to see in an investment I go for. I want to make sure they're bringing in a lot of money. Over here, we can actually see the net profit margin, 32% there. So these guys are making a lot of money, which obviously is a huge thing that I want to make sure all of my investments have. And then finally, one stat you can find on here, if you look up here, it says inst-own. That's actually short for institutional ownership. And that means what percentage of this company is owned by the big guys, the banks, the hedge funds. So you want to make sure that a lot of the company is owned by those guys, because if they own a very small percentage of it, well, that's a little bit of a red flag. Like, what do they know that we don't? Whereas if I'm looking at this and seeing, okay, so these guys, particularly if this one, they own at least a third of it, we're like, all right, brilliant. So they see something in this company that is quite attractive. Now you might look at this and think, oh, only 38% of Google's owned by the big guys. Well, this is a bit of a unique case. So you may or may not know this, but Google actually has two different types of shares. So we've got GOOGL, and there's also GG. Now, not to overcomplicate things, but these are just different types of the share itself. It's still the same company, just different types of ownership. So this one is 26% plus the 38% we had there. So in actual fact, we're really looking at around 64% for Google ownership. So all in all, we can see Google's looking like a great opportunity, one that I'm interested in. So this is when I take it to the next stage. Just because it's a great company doesn't mean it's a great time to invest right this second. So we need to check out when we're going to buy and how much to buy. So I'm going to show you how I planned this at the time. So this is actually back at the start of 2025. You can see here, this was around February into March and April. So one way that I know makes a huge difference in my investing to make it successful is to make sure that I'm not buying everything all in one go. This is actually a mistake mistake that a lot of people make, because beginner investors say, oh, I've got this amount of money to invest, so I'm going to throw it all in one go and hope it goes up. Well, you know that there's a good chance that things aren't just going to go up, they're also possible they're going to go down, at least 50-50. So if all of your hopes rest on the fact that it has to go up, you're not going to win many. So in actual fact, a better way to do this is to split your investment into multiple increments and invest some at a level. Then if it goes up, great, quick profit. The other 50% of the time it's going to drop, and you can buy some more. So you're buying it at a cheaper price each time. And this is actually the concept of averaging, which is a fundamental principle in investing, and one I would strongly suggest every investment strategy to have, because it just means you don't need to be right the first time. You don't have to put all your eggs in one basket and need it to go up for you to make a profit. You can buy this asset as it gets cheaper over time. And that's how you need to think of it. So with this specific stock here, Google, I had decided to split my investment into 3 stages, 3 different entries, which I've put on here with a blue line. Now, the way I did this is actually using a special calculator that I've created called the VAX calculator. But essentially all it did was take my chosen investment amount and break it down into 3 individual chunks. You can see here, this was the first time I entered. It was around the 25th of February. So at this point, I invested a chunk of the money. Now, another interesting thing is it wasn't split into even parts either. Because not only do I like to invest as the stock drops in price, but I actually like to invest more money at each stage. So I'm buying cheaper, but also more. So I bought a percentage here. And then as the stock dropped, which it clearly did quite a bit further, at this second stage, I invested more money and I ended up buying the stock at a much cheaper price as well, which is great. This lowered my what's called an average price. Then I'd actually also had a planned investment down here too at this third stage, but as you can see, it never reached there. But for me, that's fine. It bought at my first 2 entries and then soon after it shot up. So maybe I didn't get all of my investment funds in, but I did get a much quicker profit than I'd intended. Now, by investing at this entry and this entry, I had an average price, which is essentially the culmination of all my investments together, the collective, meant that my average was around this price here. I'm just going to put this as red. This is what's called in business your break-even point, where as soon as price goes above my break-even, my average, I'm in profit. So it doesn't actually matter I bought here, it doesn't really matter I bought there. What matters is the overall average of that investment. And because I bought more at this cheaper price, you can see the average is a little bit lower than halfway between them. So that's good. That's a really good thing. You want your average price to be as low as possible. For example, if you bought one stock at $20 and you bought one stock at $10, your average would be 15, it'd be bang in the middle. But because I bought more at the lower price here, invested more money, it's brought my average down even further, which is a good thing. So I knew that as soon as the price of this stock goes above my average, I'm in profit. Well, as you can quite clearly see, it went quite considerably above this, which was great. But I do something when it comes to profit taking that most people do not do, particularly if they're trading. In trading, you typically have what's called a take profit target. And that is saying, right, when the price gets to this price, I'm going to sell. I'm going to take my profit and move on. That's okay if you're doing very short, fast-paced trading where you're trying to make a little bit of gain. But when I'm investing for, a few months at a time, I want to make quite a considerable profit on that to make it worthwhile. So instead of setting a target and then selling at that point, I put in what's called a stop loss. Now, a stop loss is essentially a safety net. So what it means is I get to a certain amount of profit and then put in a safety net just below that, which means, well, the stock can either keep going up, great, because then I can keep bumping up my safety net, my stop loss, or the price could suddenly drop, it's going to hit my safety net and sell the shares automatically. So this actually means the selling is quite automated. I don't need to be sat in front of the screen waiting to press the button for it to happen. But what this also does, it removes the emotion, because you deciding that, oh, that's enough profit, that's just an emotional decision. If you ever say, I think or I feel when you're making investment decisions, feelings are getting involved and that is not a good idea. So instead, I say, right, when I get to this amount of profit, I'm going to put in my safety net. If the price then goes up to this amount of profit, I'm going to bump up that safety net. And I'm just going to keep following those increments up the whole way so that eventually the stock will drop, hit the safety net and sell automatically. So as I did it in this one, I was following this stock up, it went higher and higher and higher, actually got to some very considerable profits. But I was taking out around this price here, which, as you can see, if I show you how much above my break even, it was a pretty tasty sum. It was in the low 50% there on this one investment. Look, I was in this for a few months. Like, it wasn't an overnight success, but 52% profit in 4 or 5 months, not bad at all. So that was a great investment, of course, but it doesn't always work out like that. So let me show you another one that didn't turn out so well. So I looked for Amazon, another huge company that obviously everybody's familiar with. Now, just looking down at the stats of this today, the fundamentals, these differed a little bit back when I actually did invest in it, but at this stage, they're pretty similar still. So size of the company, it's $2.2 trillion in size. Their sales are still making $716 billion, so they were doing okay. Profit margins, 10%, so a little bit lower on this one, but still pretty good. And the institutional ownership, 66%. So pretty much 2/3 of this company were owned by the big guys. So for me, I see that as a real positive. They obviously believed in it. So once I decided on Amazon, very similar process to the last one. one, I decided how I was going to split my investment up into different stages. Now, on this one, based on the stock itself, I decided to split my money into 4 different increments, whereas the last one was 3 different. So this one was 4 different increments. And you can see here, I've put it here as entry 1, entry 2, entry 3, and entry 4. Now, on the last one, you might remember, only the first 2 entries got invested, whereas on this one, we actually got the first 3 were bought in. So it was a chunk of money here, and then a slightly bigger chunk on this side, slightly bigger chunk again on this 3rd entry, and then this 4th one didn't actually hit. So again, not fully invested. We still had a plan just in case the stock kept falling, because I love to have that contingency in place, but it didn't. It actually started to rise quite quick, which is cool. So once I'd done these 3 investments here, here, and here, my average price, again, my break-even point, was somewhere around, it was actually pretty low. It was somewhere around here. I'll put this as a red line once again. This is where my average was. Now, what was good here is after I'd made that 3rd purchase, you can see it actually started to rise a fair bit. Now, one thing I did on this is I put that first stop loss in, the safety net. I put it in quite early because it hit a decent amount of profit quite quickly. So I'd put my safety net in. But what you can also see is it rose above my break-even here, but it came back and hit that stop loss relatively quickly. So it actually sold it out at quite a small percentage. So I think on this one, it may have even been like 2 or 3% profit. But what's quite interesting there is that first stop loss went just above my break even. Now just think about this conceptually. Putting that stop loss just above break even means this is now a risk-free investment, because if my worst case scenario is the price is going to come back and hit my stop loss just above my break even, well, it means I'm going to make a couple of percent profit. So essentially just get my money back that I invested and a little bit extra just to cover any fees that the broker charges. If the worst case scenario is I'm just going to get my money back, that's a pretty strong position to get into. So that's actually my first target with any investment. Just cover myself so I know I'm not going to lose anything. Because rule number 1 of investing is don't lose money. And as Warren Buffett says, rule number 2 is to remember rule number 1. So I always cover my downside there. Now in this example, I did put that in, it covered my basis, and then it did come back and hit that relatively soon. So I got my money back plus a few percent profit, and I'm like, okay, cool. That wasn't one of the ones that's going to change my life, but solid investment, got my money back, didn't lose anything, on to the next one. So that right there is exactly how I invest. The great thing is, once you've done that process enough times and it becomes second nature, the carefree feeling right there is amazing, because you're not stressed about every single individual investment like I was then. One of them did really, really well. One of them didn't do as well as I'd wanted, but that's fine. Overall, I made a profit, and that's all that matters. As long as your account is growing consistently, you don't worry about the individual investments. You worry about your portfolio as a whole. I tell you this, the people who try and hit home runs on every single investment, they're the ones who take too much risk, and inevitably they end up losing big as well. So instead, steady, gradual growth with every investment is a much better way to secure wealth and actually build the freedom you're looking for. And by just repeating a process consistently on every single investment, you can start relying on the system to take care of it rather than just you and your decisions. Because when you remove the human element from your investing, it's amazing how much more successful you could be. So if you've been putting off investing because it felt too complicated or too time consuming, or like something that you'd figure out later just one day, this is the moment to stop waiting, because later gets expensive. The free online masterclass in the description is the best next step. It's free to attend. It walks you through the full VAX framework in a lot more detail, and it will show you exactly how the Trade Tribe works. Come and see what's possible. Subscribe for more content like this, and I'll see you next time.